Navigating the global chessboard, the impact of geopolitical risks on currency and commodity investments. Introduction. In the interconnected world of finance, geopolitical risks emerge as potent forces capable of reshaping the contours of currency and commodity markets. As nations jockey for supremacy on the global stage, their political decisions, conflicts, and alliances send ripples through financial markets, impacting investors and traders alike. Understanding the intricate dance between geopolitical events and currency and commodity investments requires a deep dive into the multifaceted relationships that underpin this dynamic. Geopolitical risks defined. Geopolitical risks encompass a spectrum of uncertainties arising from the interactions between nations on the global stage. These risks can manifest in the form of trade tensions, armed conflicts, diplomatic standoffs, sanctions, or geopolitical events that disrupt the status quo. In the financial realm, the impact of geopolitical risks is particularly pronounced in currency and commodity markets, where the value of assets is intricately linked to the stability and strategic positioning of nations. Currency markets, the barometer of geopolitical tensions. Currency markets serve as a barometer of geopolitical tensions, reflecting the ebb and flow of risk perception among investors. In times of heightened geopolitical uncertainty, investors often seek refuge in safe haven currencies, traditionally the US dollar, Swiss franc, and Japanese yen. These currencies, perceived as havens of stability, tend to appreciate as investors move away from riskier assets. Consider the scenario of a geopolitical crisis unfolding in a region. The affected country's currency may experience a sharp depreciation as investors lose confidence in its economic stability. Simultaneously, safe haven currencies witness an uptick in demand, reflecting a flight to safety. The value of the US dollar, for example, may surge as global investors seek shelter from the storm, illustrating the intricate link between geopolitical events and currency movements. Commodity markets, supply chain disruptions and price volatility. Geopolitical risks inject a dose of uncertainty into commodity markets, impacting the production, transportation, and pricing of essential raw materials. Supply chain disruptions, triggered by geopolitical events, can lead to fluctuations in commodity prices, affecting industries and investors worldwide. Consider a geopolitical tension that disrupts a major oil-producing region. The resultant supply constraints may propel oil prices upward, impacting not only energy markets but also reverberating across sectors dependent on oil as a key input. Gold, often dubbed the safe haven metal, is particularly sensitive to geopolitical risks. In times of political uncertainty or crisis, investors flock to gold as a store of value. The precious metal's price tends to rise during geopolitical turmoil, reflecting its perceived role as a hedge against currency devaluation and global instability. Trade relations and currency values. Geopolitical events can reshape trade relations, influencing the value of currencies. Trade tensions, tariffs, and trade agreements all contribute to currency movements. A prime example is the US-China trade war that unfolded in recent years. As the two economic giants engaged in tit-for-tat tariff impositions, the Chinese yuan experienced depreciation, while the US dollar strengthened. Investors closely monitored developments, adjusting their currency portfolios to navigate the evolving landscape of trade relations. Sanctions and their ripple effects. Geopolitical tensions often lead to the imposition of sanctions, restricting the economic activities of targeted nations. These sanctions can impact both currency and commodity markets. For instance, sanctions on a major oil-producing country can disrupt global oil supply chains, leading to increased prices in the oil market. Simultaneously, the currency of the sanctioned nation may depreciate as economic sanctions take a toll on its financial stability. The role of political stability in currency valuation. Political stability is a key determinant of currency values. Geopolitical risks, such as political unrest or regime changes, can significantly impact the perceived stability of a nation and, consequently, its currency. Investors wary of political instability may divest from the affected currency, seeking safer alternatives. Conversely, a nation exhibiting political stability is likely to attract foreign investment, supporting the strength of its currency. Strategies for investors. Navigating the impact of geopolitical risks on currency and commodity investments requires strategic foresight and adaptability. Investors often employ various strategies to manage risk and capitalize on opportunities. For currencies, diversification across a basket of currencies can mitigate the impact of adverse geopolitical events on a single currency. Additionally, monitoring political developments, understanding trade relations, and staying informed about potential sanctions are integral components of informed currency investment decisions. In the realm of commodities, staying attuned to geopolitical events that could disrupt supply chains is crucial. Hedging strategies, including futures contracts, can help manage price volatility resulting from geopolitical shocks. Gold, as a safe haven asset, may find a place in investors' portfolios as a hedge against geopolitical uncertainty. Conclusion. In the intricate dance between geopolitics and finance, currency and commodity markets emerge as arenas where the global chessboard comes to life. Geopolitical risks, with their potential to reshape trade relations, disrupt supply chains, and influence investor sentiment, add layers of complexity to investment decisions. As geopolitical events unfold, investors must remain vigilant, adapting their strategies to navigate the evolving landscape. Understanding the interplay between geopolitical risks and currency and commodity investments equips investors with the knowledge needed to make informed decisions. Ensuring resilience in the face of the ever-shifting tides of global politics and economics.